Hey guys, welcome to The Market is Open. Tesla recently reported massive record deliveries of over 139,000 vehicles and incredible earnings results to go with it. This is the fifth quarter in a row of profitability for Tesla. Margins for the automotive business are also on an upward trajectory, something Elon Musk had been saying would eventually occur. Even the battery storage business is beginning to see immense growth, and Tesla's small solar business has begun growing once again with the launch of new products. This picture of Tesla completely goes against what the bears have been saying for years. The argument that Tesla is structurally unprofitable has gone out the window. The competition is coming. No, the competition is on the verge of collapse. They can't even bring out an electric car, and Tesla's already like 2,000 iterations in. Tesla needs to raise capital. No, not anymore. There's no demand. There's so much demand they can't even keep up with it. Tesla can't make a profit. They just did 5 times in a row. But what about the emissions credits? They're still profitable even without that, but what other company do you know that's getting free money? Every time there's an argument, Tesla comes through, solves that issue, and then the bears are forced to move on to something else. So today we're going to look at an interview with Tesla Bear Craig Irwin and what he thinks the next issue or bear case for Tesla is, even after this stunning earnings report that not a single bear thought possible even just a year ago. Before we begin, please hit the bell button to subscribe and be notified of upcoming Tesla videos, and smash the like button at any time to help support this video. We'd super appreciate that. You can also support the channel at patreon.com/themarketisopen, where we give a shout out to our patrons at the end of each video. Also, stop using Yahoo Finance, stop using Google Finance, and have a look at our website, themarketisopen.com, where we have instant stock quotes and financial data for every single company going back 9 years, and it's all freely available. Craig Irwin is an analyst, managing director at Roth Capital. We've discussed his views on Tesla in previous videos. This one here with his debate with Gene Munster from a few months ago. Craig has been quite bearish on Tesla in the past. Here's a hilarious clip with his interaction with Ross Gerber.
I'm not a weather vane. I'm an analyst. My job is to break out the calculator. We're going to see decelerating growth. Competition is coming that's real.
Everything that Craig said is demonstrably false. I don't know where he gets his numbers. He probably pulls them out of his weather vane.
Craig has been dead wrong about Tesla in the past. If you listened to him, you would have missed out on many hundreds of percent gain, and if you had shorted the stock, you'd be down hundreds of percents. So after Tesla reported the most recent blowout quarter, strength in all aspects of their business, running on all cylinders or all motors or whatever, Yahoo Finance was like, well, who better to have on the show than Craig Irwin? He knows about Tesla.
What did you think of the report?
I think the report's fantastic. I think really they came through on automotive gross margins, 27.7%. Beat what people were looking for by about 350 basis points. So
now, surprisingly, Craig Irwin starts off by saying that he was actually impressed with Tesla's quarter. He calls the results fantastic, specifically with the margins. The margins were 3.5% better than anyone was expecting, and analysts love margins. That's all they talk about. If you go back to pretty much any Tesla conference call, or any conference call for that matter, there's always a question about margins. All analysts think about is margins. I mean, margins relate directly to how much revenue is being converted into earnings, and that's extremely important.
strong on the top line, strong on the bottom line. They did it, but that's not what the valuation is driven by.
Wait a minute, that's not what the valuation is driven by? They just delivered 50,000 more vehicles in the previous quarter, 55% growth in deliveries after one quarter. Margins were off the charts, but we've moved on to something else now?
The valuation is really driven by autonomous.
Sorry, but since when has Tesla's valuation been driven by autonomous or full self-driving? First of all of Tesla's full self-driving revenue is already baked into the average price of the car. Actually, that's one reason why they have such great margins, because a large component of the vehicle's selling price is this software. But if you ask any analyst to value Tesla, they're going to start off with the number of cars they delivered, followed by revenue, then margins, and eventually it gets to profit. There's really no autonomous in there, as Craig is saying. Actually, Tesla bulls have been saying for years now that the autonomous driving opportunity is huge, and no one is factoring it in. And so for Craig at Tesla Bear to say that the valuation is driven by autonomous is just dead wrong. People are barely factoring in the battery storage and solar businesses. Elon's saying that energy can be just as large as vehicles. It would be nice if people factored in the self-driving robotaxi opportunity, but that's simply not the case. If it were, you would likely see Tesla have a huge valuation increase, reflecting far beyond what they are capable of doing in vehicles alone. But no one knows how to value this opportunity. ARK Invest, an investment firm, has been ridiculously accurate with their Tesla predictions, despite sounding crazy to some people at first. They estimate that based on future cash flows, you would expect $1 to $2 trillion in valuation increases today. No one else is looking at that seriously. Craig Irwin has the opposite view, however. Just before Tesla released its FSD Beta, he felt that this beta would negatively impact the stock if it had problems and caused accidents.
Realistically, if those vehicles that were turned on for full autonomous beta this week do disappoint or end up having accidents or other problems, you could see a very severe impact in the valuation.
I think that's the wrong way of looking at it. How is Tesla going to progress if they can't release new software? Also, Tesla is rolling it out carefully to people with more experience at first, and then they continue to fix any issues before rolling it out to a wider audience. It's a great continuous development software model, and it allows Tesla to get rapid feedback and iterate quickly with these new changes all the time. Not a single competitor is able to do this, which is why they are falling further and further behind Tesla. Now, if the valuation is driven by FSD, then these analysts should take a look at the FSD Beta because it seems to be significantly better than what Tesla had before, and it's now feature complete. It can handle pretty much anything. However, there's still a long road to making it more robust in many different areas. One thing that Elon Musk says is that this new rewrite will improve at a faster rate than before. And secondly, if you compare Tesla to the major players, every demo or video that they put out is made by the company. You don't know exactly how the video was made. You can watch GM's Cruise video that they published recently, which was sped up at 2 times the speed. Like, what is that? You can't even tell what's going on in the video. And it could have taken 100 tries to get one great demo. With Tesla, all of the videos online are made by regular customers, so you see what works and what doesn't. The current system is far from perfect, but it's a significant step in the right direction. So with that news, Craig Irwin should be buying Tesla hand over fist. However, Craig might be getting his information from Consumer Reports, which is also a little confused and probably didn't get to use the FSD Beta either. These other systems can't even be tested with real customers, and most of them have driver assistants not fully driving on their own. Where are they getting the millions of miles of data and the edge cases to train their systems if no one is using them and they all rely on LiDAR, which no cars actually have? However, Craig believes that Tesla's behind in the autonomous game and is trying to catch up. He cites that Tesla's onboard chip does 76 tops or trillions of operations per second, while he believes that 1,000 or even 10,000 tops is what's needed.
It's not so well anchored in reality. There's other companies with superior technology coming to market. Tesla's chip that they use for AI for interpretation of the image is 76 tops, trillion operations per second. There's a chip coming in the first quarter from a competitor that does 1,000 tops.
So I mean, it's clearly working with what Tesla has right now. I think it's actually 72 tops, and there's 2 of them for redundancy. And at least for the previous version of FSD, Elon was saying that only a small fraction of the chip's capabilities was actually being used. Craig might be right about this larger performance estimates for competitors, however, because almost all of them are using LiDAR, which probably requires a supercomputer on board of each vehicle to process that data. And with all of that computing power, it affects the range of the vehicle because they use more power. Contrast that to Tesla's Hardware 3, which was designed to keep power consumption low. However, what Craig is really missing here is that the real brains behind the full self-driving strategy are not located in the vehicle, they're located in the data center. Tesla has built custom chips in the back end for actually training their neural nets with all of their data. The chips in the car just execute the final neural net logic containing the weightings or the final resulting algorithm. But in order to create that algorithm, it's the data center, or what Tesla calls Dojo, which will power that system.
So Tesla's been far more aggressive in actually getting things on the road than everybody else, and that's one thing that I like a lot. Emerging suppliers are taking much lower risk approaches. They're looking to maybe automate trucking to an extent so that the impact of trucking accidents is greatly reduced. Handling things in rail yards and other industrial uses where the technology can be incremental, and you don't need neatly curated lane markings for the stuff not to cause accidents.
Now, Craig Irwin says that other OEMs are taking safer approaches than Tesla, but tailoring their self-driving solutions to trucking and rail yards where you don't need lane markings for stuff not to cause accidents. I'm not sure what he's talking about here. First off, trucking may be much higher risk since it's pretty much all of the same risks as a consumer vehicle, but it's carrying potentially millions of dollars worth of cargo. Tesla is actually targeting the trucking market as well with their Semi at the same time. The FSD hardware will be the same on the Semi, Trucks still need to drive on public roads, so Tesla's system will be far more robust in the end than anyone who's just focusing on trucking alone, whatever that means. Craig Irwin's take on Tesla has been misleading to investors. He points out something positive, such as China's on the upswing, Tesla will soon be opening up in India as well. But then his analysis of these points results in something negative, such that even with China and India, they're still nowhere near selling 17 million cars that he believes they need. And so this type of analysis is short-sighted, only looking at certain data points and not thinking about the future maybe 5 to 10 years out. Tesla is in its early stages in terms of vehicle sales, but the growth of their EVs and their plans to expand battery production and eventually sell 20 million vehicles as one of their ambitious goals will make this comparison with the traditional automotive industry obsolete. Tesla's vehicles are high margin and their manufacturing keeps getting better and more automated. And a large component of their revenue is software today, and when the robotaxi network comes online, an even larger percentage of revenue will come from high-margin software and services. Craig is saying that autonomous is what's driving Tesla's valuation. However, when Tesla released its FSD Beta software, the stock didn't move at all, except that the software itself witnessed a hockey stick level growth after a long period of small enhancements to Tesla's autopilot. If anyone noticed the difference between the previous FSD and the FSD Beta, according to the hundreds of YouTube videos from different consumers, then the stock would have jumped. Except that I don't think analysts believe that self-driving is possible. Even Craig Irwin is saying that this is something that might occur in 5 years from now. Look, he might be right, but what happened literally overnight, about 2 weeks ago when Tesla flipped over to their full self-driving beta for some users, was a step function improvement in full self-driving capability that is unthinkable and not thought possible by these analysts who work for big money management firms and basically control Tesla's stock price. And so I think Craig Irwin is wrong when he says that the valuation is driven by autonomous, but I agree that he should be right about this. This thing works pretty well right now with just cameras, and they have radar, but there's no LiDAR, and there's no remote assistance people, and this thing can be supported by over 1 million Teslas today. And for the 10th time in this video, the FSD Beta is being tested by real customers today. All of FSD is being tested by real customers. There are no other players in the world today that have this kind of unique edge case data that Tesla has. No one has built a custom supercomputer that can train AI algorithms using this unique data that only Tesla has. Everyone else is relying on LiDAR, which doesn't exist on any vehicles today. They don't support over-the-air updates, which is critical for full self-driving, and almost no one else is producing vehicles that even have the surround camera hardware so that the car can drive itself. It seems like Tesla is far ahead on multiple fronts, and if the valuation was based on autonomous, then Tesla would be much higher today. Alright, I hope you guys enjoyed this video. Please hit the like button on this video, we'd super appreciate that, and don't forget to subscribe and hit the bell button to be notified of upcoming Tesla content. You can support us further on Patreon at patreon.com/themarketisopen, and a very special thanks to Bradford Ferguson of Halter Ferguson Financial and all of our patrons that help to support our channel. Your support helps us to continue to make great content. Thank you guys so much for watching.